Hey gang, welcome. This is The Big Picture with Jeff Zunaneri and Roger Scott. I want to welcome you guys here, and I want to make sure everybody had a nice holiday weekend. Jeff, did you have a nice holiday?
Yeah, it was fantastic. Thanks. How
Good.
was yours?
It was great. It was great. It's great to see you. It's the only time of the week I've been getting a chance to talk to you about the markets, and boy, oh boy, things have been turbulent lately. Hopefully,
Yeah,
this week we'll see each other again on the midweek roundtable. I don't know what your schedule is, but we'll figure it all out.
yeah.
So, this week, I was looking at the Fed data. I was looking at everything on the table. I waited till to do my analysis till a little bit later in the week.
hmm
Wanted to see how things were going to go, and noticed that we've got a lot of talking heads this week. This is last week's data. This is this week's data right here.
Okay.
You've got, look at this, Brainerd, you got Mester, you got Barr, Mr. I'm not going to say anything till I get reappointed, Powell, but not a lot of data outside of the Fed. And in light of that, I've also noticed something very interesting happening, something that I've been talking about for quite some time, and that's this. That's the bond market finally breaking down. Something that I was hoping that was not going to happen, but the reason why we only trade in the direction of the trend is because things like this may happen. So what do
Right.
you make of this? What do you make of this? What do you make of the market? We all know that September historically is not a great month. Is this going to pull the market down? Is this just a hiccup that's going to come back up? What is your take here?
I mean, we're in a bear market, Roger. We have been all year. We had a bull market rally, a textbook bull market rally in July that sucked in a bunch of new money, and the Fed didn't like it. So people don't want to fight the Fed when they're providing liquid crack via cheap capital, but they're going to sit here and be in denial about the fact that the Fed is withdrawing money from the market uh, at an unprecedented pace in September, about $95 billion this month of quantitative tightening on the docket. Short answer is we'll have blips of upside met by more selling. In the shortest of runs, like today, we're mega oversold right now. We're mega oversold right now. And the bonds are also oversold. Stocks are oversold and bonds are also oversold in the very short term. Um, I think the bonds have have a harder cap on how high rates can go than the stocks do, specifically the growth stocks on how low they can go, because a lot of them are just BS companies anyway. So be very careful with those. But yeah, it's a doozy, man. Have you looked at like the Nasdaq, how bad it is? I mean, down what, 27%? I think down almost 10% in a straight line since Powell gave that speech on
Yeah,
Friday
yeah.
over
And
a week ago.
the main question that I have now is whether the Nasdaq is going to come back down to this base and kind of mimic what the long bond is doing, or if it's going to start coming back up. Because I agree with you, this is a little
It's going to come
overdone.
up. It's going to come up. It's going to bounce. We're oversold, but it's not a tradable bottom, is the point that I'm making. And neither was 2 months ago. And any people that keep chasing that pattern from an investment standpoint are going to continue to feel pain and find pain. So that's my point of view on it. Until there are a few catalysts that could change a new year always changes things. A political shift via election can also change the feelings. But September and October, as we always talk about, tend to be pretty bearish. I mean, Stock Traders Almanac, historic data going back 100 years. September's the most bearish month
Yeah.
of the year historically.
Yeah, negative four. It's either negative 4.8 or 4.6%. I don't remember which one, but it's one of those two
Yeah.
that it goes down. This is the right now what you're looking at. This is the number of stocks in the entire stock market trading above $2. And we showed, right here when they peaked out, right when they hit that 8.6 hump, I drew this line here, and they look at that, it hit them right there, and now they're coming back down. So my question right now is this going to come back down all the way? Or are we going to start having a little hiccup, as you said, and then pulling up here and then coming back down? Because I mean, this is a pretty straight line, and I agree with you. It does look like it can use a little bit of a pullback. But Overall, it looks like, I mean, it looks like it can go more. And also, what's interesting is if you look at consumer discretionary, we're sitting right at that in that area right there, and theoretically, I mean, theoretically, if the bond breaks, my theory was if the bond breaks that low, this can come a little bit lower. But then you've got sectors like KLC that are already bottoming out, and see that they're already making new lows. And what's
Yeah.
interesting, when I was looking at my momentum levels this morning, remember I was talking about this, how this is going to start looking like this, and it's definitely, remember this was at
Yeah.
97%. It's
Yeah.
now, this was at 97, 95% 2 weeks ago. Now it's at 31. But take a look at this, Jeff. Real
Sea of
estate,
red.
yeah,
Wow.
all red. I mean, this is looking just like this now, pretty much, except for energy. Which, remember that example that I gave with the Great Dane? How the Great Dane can only go so far, and then we have to pull it back. Well, we've pulled it back. The foundation was strong in energy and utilities, and it still is. But here's my point.
Yeah.
Um, if you look at, and this kind of goes with what you were saying, and I was kind of talking about that this morning, that even on the 50-day line, and this is the emotions right here. This is that dog running away from us. If you look at real estate and if you look at communications, I mean, how much lower they're going to go? They're pretty much the same as the 200-day. So I'm like maybe consumer discretionary can lose a little bit more, but I think we're getting to that line. We're getting to that bounce level too. It seems that way, right?
Yeah. I mean, the problem is we keep coming in. I actually think we have to get a technical organic reversal. So today is kind of, and we're filming this for people that might watch this later. We're filming this at 10:30 in the morning with the S&P down almost 1%, the NASDAQ down a little bit over 1%, after the futures were solid green pre-market. And so the problem is we've had like this pattern of the past 3 or 4 days where we've had futures fail. So up, fail, and then we've closed on lows. What would be a break from that pattern would be to have a day where you have deep selling in the morning met by really heavy volume buying in the afternoon, reversing not only the losses for the day, but going way above and beyond that into the day, prior day's losses. So a key day reversal by definition would be you have a close the day before that's low. You have a new low made in a series of down candles, but then you close that same down candle day, you close above the previous day's high. Now that would be a tall order from here, but not impossible. We get one of
No,
those,
no.
we get one of those, and on no news, even better. And then we have a nice technical bounce to work with for a little while. But I'm still, mainly concerned with the fact that the Fed is so hawkish. The Fed is just so hawkish.
Yeah.
They're just like, you know, they were, and I've said this to you 1,000 times, I think, on these shows, Roger. Only thing they've proven to us is the ability to do everything wrong. So why am I going to start to think that they're going to do things correctly? They have a pattern of incompetence or whatever it is. They do the incorrect thing. I don't care why. They just do the wrong thing. So I expect that to continue mainly. The wrong thing, from my perspective, would be for them to stay hawkish for too long and to raise rates into a nosediving economy, because you can have the jobs, which is the only thing that's really holding up in this economy right now. You could have the job market crash in a few months. You can
Yeah.
go from 3.7% unemployment. We've seen it. You and I have been through a lot of bear markets and a lot of economic cycles. How fast did the 2008 job market go to double-digit unemployment? It happened in the summer/fall of 2008. We went from normal to no, everybody's out of work. So they have to be very careful, I think.
I agree with you. Are there any specific, in light of this point where we're in right now? Are there any specific sectors that look appealing to you, or anything that you're looking
I
at?
like discount retailers. I like the Dollar Generals, the Dollar Trees, the Ross stores. I'll give you guys a free money flow elite trade because it just came out today. So I have this service, Roger, that that tracks institutional money flows. And one of the standout stocks in this really bad month so far to start was Dollar General, DG. That's a stock I like. That's a sector I like. Uh, they historically tend to do well in bearish markets, in recessions, in high unemployment phases. What tends to happen is people that are in the middle class, they're still in the middle class, but they start to try to find discounts on basic household necessities like, toilet paper, paper towels, dishwashing detergent. And you go to a Dollar General and it's substantially cheaper than going to a Target, for instance.
Yeah, I agree with you. I've been saying the same thing. I've been really bullish on Dollar Tree, Dollar General, all the discounts, all the discount stores, also Ross stores, and
Yeah,
I think all those stores because people are going to be going, from people that were shopping at Macy's are going to be going to. It's just everything goes one level down. So
totally.
I think those stores will start seeing some, and I like these because ultimately these stores focus on mostly consumer staples, and people are still going to need their cereal and they're still gonna be drinking their milk and they're still gonna be eating their gummy bears, and that's the kind of things you get at these stores, and toilet paper and so forth. So I agree with you. What about Dollar Tree? Do you like Dollar Tree or do you like
Love
just
it. I love
yeah?
it. But just DG came up on my schedule because of the volume. The differentiator, I think, was this volume, it was mega volume on DG to start September. So that was a big differentiator. But stocks, Dollar Tree is so oversold. They had a little bit
Yeah.
of worse earnings than Dollar General. It was an execution thing, but they cleaned that up and the trend is still there. They did have a really good aspect of the research report. Dollar Tree, I'm talking about, where they had a record number of households with above $80,000 a year in household income shopping through their stores. They track that. They do a survey. So they had the most ever. So that speaks to that phenomenon of people coming down from other stores and coming through theirs.
So you're from what I'm understanding, you like consumer staples. You like the lower cost consumer staple stores from
Yeah, because I think it's going to be a little bit. I think tech is still. I mean, let's face it. A lot of tech is overvalued still from a PE. There's a lot of air still in some of those prices, even though they've come down so hard. I don't think the earnings of 2020, of the real, like, the recession hasn't really hit, right? If it does really hit, which the Fed looks like they really want it to hit, um, these stocks are incredibly expensive on a forward basis, fundamentally. Some of them, like the generals of the Nasdaq of tech. So I like them for a trade, but from a longer term thing, they could get hammered, another 25% easily.
It's interesting that you mentioned that. I don't remember exactly. I think it was either Barron's or Bloomberg, but I was reading this weekend and they were talking about historic PE ratios
Yeah,
on the S&P. And they were saying that in almost every recession that we've had, we've seen the PE ratio on the S&P go down to between 13 14. That was the level that they saw. And right now we're in the 16 territory. And
right.
they said that if they were to put that on the S&P right now, we would be somewhere right around here. Let me just show you. Right around right around this territory right here, somewhere between
So
33.
20% lower back of the
Yes.
napkin. Another
Yeah.
60, a little less, but
A little,
17
yeah, like
something percent.
17. Right,
Yeah.
right. And when I did my analysis, I said the same thing that I think we can go slightly below the weekly 200-day moving average, but
Yeah.
not too much lower. Do you see this? Are you in agreement with that at least for now? I mean, and I know, look, I know if I ask you this question 3 months from now, the answer may totally change, but as you're sitting here right now, do you think that's being pretty reasonable, or
I
do you
think
think?
there's another 10% of downside in the S&P 500 for this year. So from this level, maybe slightly above that, more close to the 356 on the SPY.
Right around the 200-day and the weekly?
That's right there. I think we might base. I think that's probably lows. I think another 10% below. So that means for higher beta stocks, maybe another 20%. And I think the NASDAQ has maybe another 15% downside this year,
That
which isn't
makes
a
sense.
lot. It would be a 40%
Yeah,
down move in a year on the
yeah.
NDX, which is a lot for an index. one of the worst. It would probably be one of the worst years in the last 50. But
Yeah, it would probably be the worst year in the last 50, actually, if you think about it on a year over year basis. Um, but let me ask you this: right now, we're having some stuff going on in Europe. We're having some political stuff in England. China right now is starting
they're
to
shutting
focus on.
down. They're shutting down cities. China still.
Yeah,
Shenzhen. Shenzhen's a
yeah,
big ass city, man. It's a
it's a
tech
very big
hub.
city.
It's a tech hub.
Do you think that the U.S. and global economy is already pricing that most of that in, or do you think there's still some price
I
discovery
think
to come?
commodities are pricing it in. I don't think tech is pricing it in. I think there's. I think I think there's going to be more of a logistic supply chain disruption from that for manufacturing and for technology than people think about, which is inflationary. But I think that commodities are overpricing it in, like on the growth side, especially oil, from a growth standpoint, from my point of view.
So,
But
so, so you think oil? So let me ask you about oil. Talk to me
yeah,
about your view of oil in the next couple of months.
oil is going to go much higher. I mean, the OPEC Plus just came out today, and they cut oil prices in the. So Joe Biden went on like a magical mystery tour, begging like the worst people in the world to provide more oil to abate inflation a little bit. And they were like, yeah, 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 we'll hook you up, we'll help you out. Just get out of my office. And so today they did the opposite. They did the opposite, and they cut production. The Saudis basically run OPEC, and bin Salman, who's the crown prince of Saudi Arabia, he says, you know what? We don't like the price here. It's too low based on our own constraints because they can't really produce what they're supposed to produce anyways. So they lowered the official target. And even more like not scary, but eye-opening to me for people that are oil bears, they gave bin Salman, the Saudi prince, they gave him, who's also the OPEC chair, unilateral unilateral ability, which is a first, to because they have their meetings pre-registered and pre-planned, like they have them periodically, like the Fed. But they gave this guy unilateral power to just have an OPEC plus meeting whenever he doesn't like the price of oil. So what do you think they're going to do? Like they're going to put a full, the same way they talk about a Fed put back when the Fed was dovish and wanted stocks higher. There's a OPEC put in the price of oil, in my opinion.
Yeah.
There just is. There just is. And they don't want it below $100. Definitely don't want it below $90.
Oh,
So
100%. And you know what's interesting, Jeff, is in the last couple of weeks, I've noticed that if I'm obsessed with my relative strength scan. I like using it a lot, and you'll notice the same song and dance. Occidental, Enphase, Quanta, Devon, the same Nextera, Kanako, and remember, there's 500 stocks here, so and these are the top. So
yeah,
nothing has, and that's the short term one. And the long term one, when we look at, they really look. I mean,
they stand out. Yeah,
yeah, they really stand out. And I mean, on a monthly basis, look at that. Devon, Kanako, EOG Resources, American Hess, EOS. No Occidentals right here. So
yeah,
the same thing that we saw months and months and months ago. No major changes. Just tells you to keep following the long term trend.
When
Any
you're
other
investing, you have to. Unless you get to
Yeah.
such a blown out place where you might want to try a little bit stuff for long term. But to understand, you're not going to time that perfect. You'll probably be down on the position almost right away.
Is there any other very true? Is there any other stocks or sectors that you're eyeing right now from a broad perspective that you want to talk about, that you want to bring up to our readers?
It's just a very, it's so early in the month. I'm a little bit careful. Oh, there's a stock. There's a stock, and it might be crazy. And now I'm in such a generous mood today. I don't know what happened to me in September. I'm usually pretty miserly with everybody and giving away my free ideas. Roger knows that. He's always he's like, dude, I've been doing this a long time. People love the free picks. This is an internal conversation Roger and I have, not on screen. And I'm like, come on, man, these people got to pay me for my ideas. But he's like, you got to give some action against. We've had this internal discussion, so it's pretty funny. And I'm miserly, but today I'm going to be generous.
All
I
right.
like a stock, and it's going to surprise you. And it had a big flow, another flow stock, Moderna, mRNA. The stock is getting smashed again today, but to start the month, there was huge buyers with huge volume for the first time in about 5 months. And this is a counter trend play, because the trend is decidedly down. But there's a fundamental catalyst and kicker to this trade, in the sense that we are seeing massive cities still being shut down because of COVID in China. They have a lawsuit with Pfizer for their technology, which Pfizer mimicked basically to create the same what's the word I'm looking for? The shot.
Yeah, the COVID
vaccine.
Yeah. Right.
Brain freeze. But we're going in, Roger, to the flu season. September is the official start of back to school. I don't know about your house. You have kids and stuff. So do I. My kids are having the sniffles already, and I'm like, uh-oh, what do you got?
Everybody in my house.
I'm walking by everybody, like touching their head, like I'm touching people's foreheads left and right if I hear them cough. And if there's heat, there's a problem. If there's no fever, there's no problem. But we're in that time of year, and so massive institutional buying, deeply oversold. Yeah, I like it for September. I think the stock could go significantly higher from here.
Well,
I think
what's
it's
interesting,
north of $150, $160 a share.
what's interesting, what I find interesting that you named the stock, and it's a healthcare stock, and healthcare is actually, if you look at my healthcare, look at that, 20 and 20, so they're pretty much on the same level. They look like they've had it, you know. So it may not be a bad. And one other sector that I'm really looking at right now is real estate. I think real estate.
Oversold.
You've got 13% of stocks trading above the 50 and the 200-day moving average.
Wow.
I mean, that's just not a. I mean, that's like just a handful of stocks. They usually don't stay near those levels.
Right.
But I do agree with you. I think this is a time to be very, very cautious. Historically, September is not a great month. You're a little more. You're in the short term. I think you may be just a hair more bullish than me. I think we may go down just a little bit more before coming back up. But I do agree with you that we're getting near that. We're getting near that level.
I mean, typically it's going to sound weird and it's going to sound like voodoo, but it's not. But from you're a numbers geek like me. Like from a statistical arbitrage, and that's a word salad, but statistical arbitrage point of view. 7 straight days of 1% down moves in an index is like 3 standard deviation rare.
Yeah.
What I'm trying to say is to have this type of extended sell-off in the market for 7 days almost never happens. Today's day 7.
So, and look at the divergence we're having here. Even the oscillator can't handle it.
I like to play those kind of. I like to think about inflection points based on historical precedents. It breaks it, but I'll still take my chances with historical statistical precedent.
Yeah, it sounds good. I like it. Well, I think today was a great session. We learned about where you think the short term is going to go, where the long term is headed. We talked about some of the favorite stocks that you like. We talked about stocks that you hate. We talked about the tech sector, the S&P. I think we covered quite a lot of ground.
But just so I can be clear for our viewers, use that bounce that I expect to happen to lighten up on too much exposure, because you're gonna get better levels to buy back into it from an investment standpoint. And if you're a trader trading the long side, don't stay in that trade for longer than a few weeks, because it's not going to last months. It's going to last.
No, don't overstay.
I just wanted to be clear about that.
That's very, very, very smart advice. I agree with you. I have some shorts right now that I've been short for a while. I had, at Wells Fargo, it went down like 70% against me at one point. Now it's down 45. Wow. NTAP went against me 55. Now it's down only 25%. So all the shorts are starting to, kind of neutral, come back to reality. But I agree with you. I just want to end this discussion with one other thing that really lends itself to your analysis. And here it is. Let me just show everybody here. If you look at the Dow Jones, notice that we're just a little bit higher right now. And this is to the fact that the market is bottoming out in the short term right now.
Oh, it went
That
positive today. Just now?
Yeah, just now, but I want to show you this, Jeff, and I think I showed this to you last time. If you look at volatility,
Yeah, this is a full rebound happening. I'm sorry, while we were talking about it. I'm just looking at my thing too. Yeah, it's in the midst of happening.
yeah, so if you notice this whole downside here, we went from 34,300 to 31,000, and volatility only increased from 400 to 500.
Wow.
If you look at here, volatility went from 450 all the way to 750. And this case,
Yeah.
look at that, just down. Look at that, we're almost there, and we can barely get volatility. Volatility is not reacting, which is
I think we're going to run all week. I think we're going to run all week higher. All week.
Come
very
back
next week and see how right or wrong I was. But I like to put my neck on the line every now and then, make a call here and there, see if I'm right.
Well, we're going to find out soon enough. But Jeff, another terrific session. I know your time is very valuable, and I appreciate you giving our readers some of it and all the nice, juicy picks and the red meat trades that they could possibly participate in. Jeff gave you Dollar General, a Dollar Tree. We talked about Moderna. We talked about a lot of stuff.
I was overly
you were very generous.
Overly
very generous. Well, I appreciate it. Thank you so much. And folks, if you want to learn more about Jeff, and Jeff's got a lot of stuff cooking in the oven, in the back burner. You could check out all his goodies at joyofthetrade.com or Wealth Press website, or reach out to Jeff at joyofthetrade.com. My email address is support@marketgeeks.com. We will see you guys next week. Post comments, feedback, anything you need below this video. We'll respond to you. We'll comment as well. Jeff, thank you so much, and I will see you next week. Bye. Bye, everyone.
Take it easy.
Bye, guys.